Today, homing in on price falls with more to come. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, CoreLogic's National Home Value Index recorded a second consecutive month of value declines in June, down 0.6% to be 0.2% lower over the June quarter. Continued falls in Sydney dwelling values, down 1.6% a month and 2.8% over the quarter, and Melbourne down 1.1% and 1.8% over the quarter, were the primary drivers of this month's steeper drop. But housing values were also down in Hobart, down 0.2% a month and 0.1% over the quarter, as well as regional Victoria, down 0.1% over the month and up 1.2% over the quarter. Every capital city and broad rest of state region is now well past their peak rate of growth as trend rates eased across the remaining markets. Australia's third largest city, Brisbane, have seen growth in housing values flatten out to just 0.1% in June, while Adelaide remains the only capital still recording a monthly growth rate higher than 1% at 1.3%. Growth in Perth's housing values, which were temporarily showing a second wind as state borders reopened, are again losing steam with values up 0.4% in June. So Tim Lawless from CoreLogic noted the housing market's sharper reduction in growth coincides with the May cash rate hike, surging inflation and low consumer sentiment. Housing value growth has been easing since moving through a peak in March last year, when early drivers of the slowdown included rising fixed-term mortgage rates, an expiry of fiscal support, a trend towards lower consumer sentiment, affordability challenges, and tighter credit conditions, he said. More recently, surging inflation and a rapidly rising cash rate have added further momentum to the downward trends. And since the initial cash rate hike on the 5th of May, most housing markets around the country have seen a sharper reduction in the rate of growth. Considering inflation is likely to remain stubbornly high for some time and interest rates are expected to rise substantially in response, it's likely the rate of decline in housing values will continue to gather steam and become more widespread. The combined regionals index remained in positive territory, however, in June, albeit just slightly, rising 0.1%, reducing quarterly growth from a peak of 6.6% in April last year to 2% over the 3 months to June. In contrast, the combined capital cities index was down 0.8% over the June quarter, reducing from a peak of 7.1% over the 3 months to May last year. Unit markets are holding their value a little better than houses across the largest capitals, with Sydney recording a 3% drop in house values through the June quarter compared with a 2.1% fall in unit values. Melbourne also showed a smaller quarterly decline in units relative to houses, down 0.5% and 2.4% respectively. The stronger performance across the unit sector comes after house values consistently outperformed units through the upswing, they said. Since the onset of the pandemic in March 2020, capital city unit values have risen 9.8% compared to 24.7% for houses, resulting in better affordability across the medium to high density sector. As housing conditions slow, we're seeing the market swinging back in favour of buyers. And while national advertised stock levels remain 7.4% lower relative to 2021, in Sydney and Melbourne, where housing conditions are the weakest, total advertised supply is now 7 to 8% above the levels recorded a year ago and well above the 5-year average. Hobart has seen advertised stock levels jump 48.4% higher relative to last year, and inventory is 20.7% higher in Canberra. In Adelaide, where housing conditions remain quite strong, advertised stock levels are still 16.9% lower than last year and almost 40% below the 5-year average. And in Brisbane, they're down 14.9% and Perth down 16.2%. And they're also showing low advertised stock levels relative to this time last year. And they said the rise in advertised supply across some markets is mostly due to a slowdown in the rate of absorption. Estimated transactions in Sydney throughout the June quarter were 36.7% lower than a year ago, while Melbourne is down 18.3%. At the same time, the flow of new listings added to the market is falling as selling conditions become more challenging and listings move into a seasonal lull. We aren't seeing any signs of panic selling as housing conditions cool. In fact, the trend is the opposite, with the flow of new listings to the market slowing, they said. CoreLogic estimates home sales nationally through the June quarter were 15.9% lower than a year ago, but are still holding 13% above the previous 5-year average. Tougher selling conditions are evident in weekly auction results, where the combined capital's clearance rates has held below 6% since last week of May. Longer selling times and higher levels of vendor discounting rates across private treaty sales are now being seen. Rental markets remain extremely tight around the country, with rents now consistently rising at a faster rate than housing values. Nationally, rents increased 0.9% in June, taking the annual growth rate to 9.5%. This is the highest annual growth rate since December 2007, when record levels of overseas migration pushed rental demand higher. Such strong rental conditions through the current cycle have occurred largely in the absence of overseas migration, although the reopening of international borders is likely now adding further upward pressure on rental demand, they said. A reduction in average household size through the pandemic helps to explain such high rental demand during a time of closed international borders. Additionally, overall rental supply has probably been negatively impacted by the long-running downturn in investment activity between 2015 and 2021. The trend in unit rents has turned around remarkably over the past year after falling sharply in some cities early in the pandemic. Sydney and Melbourne unit rents are now rising substantially faster than house rents, with tenants taking advantage of more affordable medium to high density rental options. At the national level, rents have been rising faster than housing values for 5 months now, placing renewed upward pressure on yields. After bottoming out at a record low of 3.21% in the first 2 months of 2022, the average gross yield has increased to 3.33%. Sidebar here, of course, the net rental returns, the real returns, are much, much lower and are substantially negative for many investors. With rental markets expected to remain tight, it's likely rents will continue to outpace growth in housing values, driving a rapid recovery in rental yields. They said high yields may help to offset less demand from investors, although this sector of the market is generally more motivated by prospects of capital gain than rental returns. So overall, Australia's housing market outlook is becoming increasingly skewed to the downside, with the trajectory of housing values heavily dependent on the path interest rates take. Lawless said that while forecasts vary significantly, it's entirely possible the cash rate could rise beyond the pre-COVID 10-year average of 2.56%. Under that scenario, the average variable mortgage rate for a new owner-occupier loan would be approximately 4.96%. That's more than double the rates in April, adding roughly $720 per month to a $500,000 mortgage, or $1,439 per month to a $1 million loan. Households are likely to be all the more sensitive to rising interest rates due to record levels of debt held by the sector. Household debt-to-income ratios from the RBA indicate debt levels reached new record highs in the March quarter. The ratio of household debt to disposable income was recorded at 187.2, the largest majority, 77% of which is held in housing debt. The double whammy of high inflation is another factor likely to weigh on the household sector and ultimately housing demand, Lawless said. Non-discretionary inflation is rising at more than double the pace of discretionary inflation, which means households are likely to be saving less as they spend more on essentials such as food, fuel and shelter. And lower savings and higher expenses, along with rising interest rates, will have an ongoing impact on borrowing capacity for households. Reduced borrowing capacity is likely to further diminish housing demand and potentially deflect more home buyers towards the middle to lower end of the pricing spectrum. And higher interest rates and rising inflation are both likely to continue to weigh on consumer sentiment. Lawless said housing activity and consumer sentiment are highly correlated, and a pessimistic mindset among consumers implies a further reduction in home sales. Although sales activity remained above average throughout the June quarter, it's likely the number of home sales will continue to drift lower as housing demand cools and lenders become more cautious in their approach towards borrowers. How far housing values fall through the downturn remains highly uncertain, though, they said. However, a peak-to-trough decline of more than 10% is becoming more mainstream across the various private sector forecasts. The following scenarios vary from city to city depending on the recent and longer-term growth trajectory. A 10% decline in the market value would take national housing values back to the levels seen in July 2021. A 15% decline would take the market back to April 2021 levels, and a 20% decline would take values back to the national index in January 2021, and only marginally above where home values were in late 2017. And they also make the point that strong labour markets will be one key factor in supporting mortgage repayments and keeping distressed listings off the market. Generational lows in unemployment alongside a record high participation rate will help households meet debt repayment obligations despite rising rates and high inflation. But a key risk for housing markets would be any material loosening in labour markets, which could be triggered if the cash rate moves in a contractory selling, reducing economic output. And a substantial accrual in borrower repayment buffers is another factor helping to safeguard the housing market, estimated to be 21 months for owner-occupiers on a variable rate mortgage, meaning most households have a significant safety net if temporarily faced with a change in circumstances. And he went on to say that mortgage stress should also be minimised to some extent by mortgage serviceability assessments at the time of the loan origination. All borrowers have been assessed under a mortgage rate scenario 2.5 percentage points higher than the origination rate. And since October 2021, borrowers were assessed with a buffer of 3 percentage points. Under these serviceability scenarios, it is reasonable to expect borrowers to be able to accommodate higher mortgage repayment costs, although such a rapid rate of inflation could create some challenges for borrowers on thinly stretched budgets, Lawless said. Now, a couple of observations here. He's absolutely right to underscore that there are buffers, but remember those buffers are based on a set of assumptions about household expenditure which are now so out of date as to be stupid. Inflation has lifted costs across the board, and many people are struggling. The other point to make is that those buffers were based at a set rate of interest rates much lower than the current ones. So that means that new loans are being written with a much higher real rate once you take the buffer into account. That means, of course, that people who caught the loan just before the rate rise will be right at the thin end of the wedge. And I also want to make the point that the employment rate is artificially low at the moment, as we've discussed on many occasions, and the inflation rate is substantially understated. So it may well be that the impact on real households, as I see in my surveys, is more substantive. And in fact, in my latest mortgage stress analysis, which I've just completed, mortgage stress rose to a record high, with more than 45% of households now in mortgage stress on a cash flow basis. That's a record which I would never have thought to see, and it may well go higher later. I'll make a show in more detail on that in a subsequent appearance, but the point to make is that this is uncharted territory, and this is before the most recent rate rises really are flowing through and more rate rises ahead. So anyone who thinks that property prices are unlikely to fall are missing the point. In fact, Gareth Ed from CBA said that in early June, they updated their forecast for home prices based on revised profile for the RBA. They expect the RBA to take the cash rate to 2.1% by the end of 2022 and leave the policy rate on hold for most of 2023. Then there'll be 50 basis points of cuts are penciled in for late 2023. And their forecast for home prices are very much conditional on the speed and magnitude at which the Reserve Bank lifts the cash rate. Based on their forecast profile for the cash rate, they expect home price falls nationally of around 15% over the next 18 months. And prices in Sydney and Melbourne are anticipated to decline by more than the other capital cities. The expected falls in home prices are significant, but context is key. Price gains in 2021 nationally were extraordinary, notwithstanding there are many home owners who have bought recently. Those buyers will feel the simultaneous negative impact of both rising interest rates and falling home prices. Deeply negative real wage growth further exacerbates the downbeat feeling amongst many households, as evidenced in recent consumer confidence surveys. They go on to say, of course, the RBA does not target home prices directly, but the housing market and the broader economy cannot be separated. We expect the RBA to be aware of the nexus between changes in interest rates and the impact on home prices, household behaviour and consumer spending, and the broader economy. Indeed, behind closed doors, we believe concerns will mount at the RBA if dwelling prices slide too quickly. In the long run, there are a number of factors that influence home prices: population growth and demographics, supply, household formation, taxation policy, income growth, and policies around zoning and land release. But in the short run, monetary policy is the key determinant of movements in home prices. The RBA looks intent on front-loading the tightening cycle, and so CBA expects a 50 basis point hike in the cash rate next week. But if the RBA takes rates too high and too quickly relative to forecast profiles, we will expect bigger falls in home prices. Larger falls in dwelling prices would have a negative impact on the real economy. The RBA is placing a lot of weight on accumulated savings buffers in mortgage offset accounts to insulate many indebted households from rising rates. But whilst those buffers are positive from a financial stability perspective, households are unlikely to use money sitting in offset accounts to fund discretionary expenditure in an environment of sharply rising interest rates and falling home prices. The RBA talked a lot in 2020 about the lower structure of interest rates supporting the economy through the normal transmission mechanisms, which included higher asset prices. Indeed, we saw the power of record low rates on full display in 2021 when they turbocharged the demand for credit, and national home prices across the 8 capital cities rose by a whopping 21%. We remarked on multiple occasions over the past few years that it is the percentage change in rates that has the biggest impact on home prices rather than the absolute change in rates. Thus, changes in rates are at their most powerful when the rates are very low. The reverse of what the RBA said in 2020 will also be true when it comes to a higher structure of interest rates and the impact on asset prices, particularly given the very low level of rates we started with. Indeed, we expect an acceleration in home price falls over the coming months due to further RBA rate rises. We believe the speed and size at which home prices correct lower will ultimately act as a limit to how high the RBA will be willing to take the cash rate. Which is another way of saying, whilst on one hand the RBA is worrying about trying to control inflation, and that means lifting rates hard, to what extent will the RBA also be monitoring the fall in home prices? And I would remind you here that Jerome Powell recently said that he understood that markets and home prices may need to correct in the battle to take inflation into a controlled zone. The same is true in Australia. So it does come down ultimately to the RBA and what they do. But the point I want to leave you with is this: despite the fact that the RBA says they don't target home prices, and APRA says they have no responsibility for home prices, the truth is that interest rates and credit availability are by far the biggest levers impacting home price growth or home price falls. And now, with lower borrowing powers absolutely in play, down somewhere between 15 and 18%, high interest rates, and the prospect of more rate rises to come, this alone, of course, higher inflation, which means more expenses, which means people will be able to service smaller loans. This all to me signals significant potential falls ahead. So I have a feeling that we could definitely be in the ballpark for a 15 to 25% fall in home prices over the next year or so. And as that realization bites, more people might decide just to sit on the sidelines rather than transact. And that, of course, could be part of a downward enforcing cycle. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.